for you today is called Dependence on Great Expectations. Now, I've got some analysis here that I am really excited to share with you. Before I do, just a little bit about who we are for those who don't already know us. So Orbis has been around since 1989. We're active global investors. We describe our investing style as fundamental, long-term, and contrarian. Now, the most important one there is probably contrarian. We are fiercely independently minded, and we are willing to be very, very different from our peers and from our benchmarks when our research tells us that we should be. Currently run about £32 billion on behalf of our clients globally. In the UK, really simple range, just cautious, balance, and equity right across the risk spectrum. I'm going to talk mostly today about global balance, but a lot of the observations I make about markets would be relevant to anybody who's investing globally. Our balanced fund has been operating since 2013. Now, over that time, we're pleased that we've beaten our benchmark, but our benchmark would actually be a top quartile fund if it were in the peer group. And so if we look versus our peers in the upper right here, our rankings are really quite good. Now, a word of caution on this. When I stack them up, as you see here, it looks as though it's always smooth sailing, but we know it isn't. As contrarian investors, really the only thing we can ever promise you is that a time will come, a period will come, where we're out of step with the market and we look stupid, right? The only thing we can promise is a time will come where we look stupid. So what we care about is not the short-term numbers. Those will come in and out of looking clever. What we care about is the long-term, currently ranked 2 out of 107 funds in the category. Our cautious fund has been running since 2019. Again, the ranking we care about there is the long-term, currently ranked 4 out of 144 funds in the category. So some evidence that the approach works. We like to see that. I hope you'll learn some things today, but let me get into it. Talk's called Dependence on Great Expectations. Pretty pleased with the acronym. I'm going to spend the next 8 or 10 minutes really just talking about the US. And so why that disproportionate focus on the US? Well, that's because the US has a disproportionate weight in global stock markets. If you rolled back to just after the global financial crisis, end of 2010, the US would have been less than half of a world tracker portfolio. Fast forward to today, it would now be close to 75% of a world equity tracker. And if you're in a passive 60-40, it would be about 45% of that portfolio. So the US, as we know, has just come to dominate world stock markets. Now, how's it done that? Well, it's done that by delivering absolutely stellar returns. These are rolling 15-year returns for the S&P, going back really as far as I could get. And recently, returns have been 13.8% per annum. Now, that's extraordinary versus history. In fact, the only times in history that it's really been better were at the peaks of major bubbles, right? They sort of ended in tears. So to get 14% per annum is really an extraordinary result. Now, I ran this analysis in January, and so I may be pushing on an open door here. You may be thinking, well, the S&P has sold off. It went up before it came down. So year to date, S&P is only down about 5%. The long-term returns are still pretty exceptional. The observations still hold. Now, you've probably seen some version of this chart, right? On a newsletter, on LinkedIn, maybe a magazine, and usually accompanied with the message, explicit or implied, that what goes up must come down, right? Maybe from another value manager. Now, I may disagree with my colleagues on the growth side of things, but I really get frustrated. Where I really get frustrated is with people within the value tribe who have this sort of lazy attitude, right? Price goes up, oh, that must be bad, it must come down. That's not true, right? It's not how markets work. It is much more important to understand what drove those returns and what might we expect from those return drivers going forward. So let's look at it. Where do returns come from? Well, if you're in equities, it comes from just 3 things. It's fundamental growth, change in valuation, and dividends. If you're invested in equities, this is it, right? This is where your return comes from. Now, for our purposes, I think it's going to be useful to split fundamental growth into sales growth and then change in margins. And you'll see why in a moment. So let's go back and say, all right, S&P had phenomenal returns. Where did that come from? So we saw total return, about 14% per annum. First driver of that, companies grew their sales, right? They do that year in and year out. They grew sales by about 5% per annum. That contributed to your return. So if we have sales and we want to know what happened to earnings, we have to say, well, okay, what happened to margins? So let's take a look at those. And I've run this from the end of 2010, and you can see by that point, margins had started to recover from the lows of the global financial crisis. And since then, they've gone way, way up, right? Net profit margins have gone from about 9% to about 13% at the end of last year. Well, if you own the stock, margins going up is a good thing. It means every pound of sales is more pence of profit. Margins going up boosted your return to the tune of about 2.5% per annum. Now, if we have sales and margins together, that gives us earnings. If we want to know what happened to price, we have to say, okay, what happened to the price-earnings ratio? And so let's look at that. Pretty similar story to margins. By the end of 2010, valuations had recovered a bit from the lows of the global financial crisis. S&P traded at about 15 times earnings. I think most of us would take that, right? Pretty good price. And since then, valuations have gone way, way up, right? Currently at about 25 times trailing earnings. Once again, if you own things along the way, this is great, right? Because it means you can sell the shares at a higher price. So valuations going up contributed about 3.5% per annum to your return. That gives us price. Of course, the last part is dividends. Reinvested dividends contributed about 2%. So we started with a really simple question. Where did returns come from? Now we can answer it. Got 14% total return. About 5 of that was companies growing their sales. About 2.5 of that was margins going up. About 3.5 was valuations going up, and about 2% was dividends. Now that's the last 15 years. Of course, what we all care much more about is, well, what about the next 15? And what I want to do here is sort of just do a thought experiment, right? I want to play with assumptions for those return drivers and see where that leaves us in terms of expected return, right? I want to try to figure out, what do you have to believe to expect different levels of return from the S&P? So let's start off by just saying we want to rerun history, right? Hey, that 14% was pretty amazing. I would quite like to get that again. What do we have to believe to think we're going to get 14% again from the S&P? Now, sales and dividends are pretty stable, right? Year in, year out, they sort of do their thing. Certainly, I've got no quarrel with sales or with dividends. So that leaves margins and valuations to take a closer look at. Well, last time around, margins going up boosted your returns. What do we have to believe to think we're going to get that boost from margins going up again? So let's look at them. This is what I showed you before, right? So this is S&P's net profit margins over the last 15 years. And here's how that compares to the long term. And when you look at it in a long-term context, you see that the end of 2010 was not too bad. Right? In a long-term context, 9% net profit margin is not really that bad. But margins have just kept going way up. And so when I look at this, two things stick out to me. The first is that margins are cyclical. Right? It is not like sales that's stable year to year. They're cyclical. They move in cycles, and they're currently near record highs. From the end of last year, the only time profit margins had ever been higher was at the top of the COVID bubble. So if we go back to the math, run the numbers, and say, what do we have to believe to think margins are going to boost returns as much as they did in the last 15 years? Well, you got to believe that margins are going to keep going up, and they're going to go all the way up to 18%. Now, here's what that looks like on the chart, right? This would be off the charts extreme, higher net profit margins than the US has ever seen during the COVID bubble, during the tech bubble, even if you go back to the days of Standard Oil and the big trusts, right? The highest net profit margins ever seen by a country mile. So that's margins. What would we have to believe about valuations? Right, so let's take a similar look at them. Last time around, valuations going up boosted your return very nicely. So if you want to get that boost again, well, then valuations need to go up again from today's levels. So if we look at valuations over the longer term, there's the last 15 years. We see, not a bad starting point. 15 times is pretty reasonable. And here's what that looks like long term. And here again, the same thing sticks out, right? Valuations are cyclical, right? They are not stable over time. They move in cycles. And where they're sitting today is near record highs. The only time valuations have been more expensive was at the top of the COVID bubble and the top of the tech bubble in 2000. So we go back to the table, we run the math, we say, hey, we want to get that nice boost from valuations going up again. What do we have to believe for the PE ratio? Well, you got to believe the PE ratio for the S&P is going to hit 40 times earnings. Now, here's what that looks like on the chart. Once again, right, off the charts extreme, higher than the COVID bubble, higher than the tech bubble, higher than the go-go bubble, Nifty 50, higher even than the roaring 20s before the 1928 crash, right? You got to believe valuations are going to hit 40 times earnings. So if we want to rerun history, we want to get 14% per annum again for the S&P, you got to believe net profit margins will hit 18%, and you got to believe valuations will hit 40 times earnings. Now, if we were live, I'd say any takers, we'd be in the no camp, right? I think this is pretty unlikely, right? I think it's pretty hard to expect returns to be as good as they've been in the US. So let's walk back these assumptions a little bit, right? Let's say, all right, what's something more reasonable? And let's start by saying, you can see even Donald is struggling, right, to make the math work. So let's look at something more reasonable. Let's say, all right, maybe point taken, valuations and margins are cyclical, and they're currently near record highs. Now let's say they don't boost returns again, right? They don't go up even more from their already high levels, but let's say they don't hurt either, right? They don't detract from returns either. Well, that would leave your returns being driven by sales growth and dividends. And if they just keep doing their thing, that would suggest about 7% per annum for the S&P. Now that's not bad. Actually, in a really long-term context, it's very, very close to average, but it's half, right, of the return that you got in recent years. And that's if margins and valuations stay at their current high levels. So what if they fall, right? And here, I'm not going to look at a really long-term history, right? Really easy to make the market look expensive if you go back to the railroad days. I'm just going to look at the last 20 years. So this is basically the period since Google's IPO where big capital-light tech companies have been in the picture, right? If margins and valuations were to fall to just their 20-year averages, you would be left with a return on the S&P of about 3.5% per annum. Now, that's still positive in nominal terms, but it is way less than 14. And compare it to bonds, right? Over the last 15 years, the S&P has beat Treasury bonds by 11% per annum. If margins and valuations go back to 20-year averages, you'd be looking at a return for the S&P that is worse than bonds and worse than what you can currently get on cash. So to sum up, we really believe from this starting point, the US is dependent on great expectations, right? People are bullish on the US, bullish on the companies. That's already in the price, right? If you want to believe you're going to get a great return from the US, you got to believe that reality is going to be even more amazing than markets already expect. So since 2010, about half the return, as we saw for the S&P, came from rising margins and rising valuations. Now they're cyclical and they're currently very, very high. If they were to drop to 20-year average levels, you'd be looking at a return for the S&P that is less than bonds and cash. So that's a bit bearish, right? But what can you do about it? Now, I think here, another simple question, and I hope a pretty simple answer, but we think there are really just two things to focus on. One, seek low expectations, and two, get actually diversified. When prices are high, when valuations are high, that means expectations are high too, and so is risk. You can do yourself a world of good by simply seeking out lower valuations and lower expectations. Now, the good news there is that lower expectations are pretty easy to find because they're pretty much everywhere else in the world. If we just look at markets on a headline basis, this is PE ratio, we saw the US trading at 25 times, world outside the US trading at 15 times. But we can say, okay, we know it's sort of the growth stocks, right? Really, it's the growth stocks driving the valuation for the US up. What if we look just at the value stocks, right? Does that make the US look more reasonable? No, it doesn't, right? So-called value stocks in the US, at least according to MSCI, trade at 20 times earnings. Outside of the US, however, you can get value stocks for 10 or 11 times earnings. But it's not just style, right? We know it's really the concentration, the Mag 7, these mega companies that are driving the market in the US. What if we look at things on an equal weighted basis, right? Strip out that concentration, look at things on an equal weighted basis. We see the same picture, right? It doesn't make the US look more reasonable, even on an equal weighted basis. The US is more expensive than stocks outside the US. So step one, seek low expectations. That's exactly what we're doing in our balanced fund. If you had a passive 60-40, about 45% of your assets would be in the S&P. In our balanced fund, we found some ideas that we like bottom up in the US, but we're concerned about the market. And so we've hedged some of that exposure to the S&P. Net of hedging, we have round about just 10% exposure to the US stock market. So that's step one, seek low expectations. Step two, get actually diversified. And here, I think the way we approach this at Orbis is pretty different to how a lot of people do it in the multi-asset space. Like a lot of people are comfortable being bottom up in equities, right? That makes sense. You look at companies, you pick individual stocks. But as soon as you get into a multi-asset context, people start to think in buckets, right? And their key decision starts to be, well, how much should I have in equities and how much should I have in bonds? Now, that's not how we operate. We're bottom up through and through. The key question for us is not how much to have in stocks or bonds, but rather which individual stocks and bonds around the world are attractive enough to warrant our clients' capital. Now, I discuss this with clients all the time, and usually I get a reaction. They sort of think it sounds nice, but they struggle to visualize it. And so I thought it would be interesting to illustrate the portfolio in a different way from what you might see on a fact sheet. These are the top 40 holdings in our balanced fund across asset classes, and they're not weighted, right? The size of the bubble doesn't mean anything, but they're pretty representative. These cover about 3/4 of the fund, so pretty concentrated fund. And we can start to cut these different ways, right? We can start to break them down. We can cut them the way you'd see in a fact sheet, right? By asset class. So we've got equities, we've got bonds, we've got some commodities. We can cut them by region. So we've got US, UK, Europe, emerging markets there. But as we start to cut the portfolio look different ways, we start to look at it from different angles, things that look similar, that look correlated on one angle, begin to look different, look diversifying when viewed through another. That's true even if we just look at sectors, right? Already, we see that not all US stocks are alike, not all European stocks are alike. Many of our sector exposures are composed of companies from all over the world. We can look at things on a style basis. You know, I said it at the top, we're fundamental, we're long-term, we're contrarian. That makes us sort of intellectual cousins with a value approach. And so not surprising that you see more dots here on the right. But other things stick out too, right? You see a lot of green dots. Those are UK equities under value. I think there's reasonable value for stock pickers in the UK. You see some dark blue dots on the right. So there is value to be found in the US. You just have to look pretty hard for it. And there are dots of all different colors on the growth side, right? The US does not have a monopoly on good or fast growing businesses. We can look at economic factors, right? We can say, all right, how might this security behave if the dollar strengthens or if the dollar weakens? Now here you can see that we are not finely balanced, right? It's not an even split, and we don't want it to be. Diversification is not about holding everything you can and hedging all of your bets. When you see something that's mispriced, when you see an attractive bet to make, you want that exposure. You don't want to diversify it away. As we see it now, the US is richly overvalued versus other major currencies. And so we want exposure to securities that will do well if the dollar should weaken. We can look at cyclicality, right? If the economy does well and it's booming, if the economy rolls over, how might different securities do? And we have some things that would do well in a boom. We have some things that would hold up in a recession. We think gold, we think US inflation-linked bonds, we think the yen should do pretty well in a recession. And we've got a bunch of things in the middle that sort of don't care what happens to the economy. You know, if I pick on Genmab, that's a biotech company, right? It develops drugs. Its success or failure has everything to do with whether its drugs do well and pretty much nothing to do with the economic cycle. We can look at inflation. We look at what the market expects on inflation. They seem to think it's going to go right back down to 2% and stay there forever. We think that's pretty complacent. We're more worried than the market about inflation. And so not a surprise, you see a few more dots on the right side. Now, the key here is not actually how the portfolio looks from any one lens. The key is that securities that are grouped together that look similar on one dimension are different, are next to other stuff, are diversifying when you view them from a different angle, through a different lens. But to diversify this way, we think you really have to be bottom up, right? You have to go around the world company by company and really understand every individual security that you own. Now that's how we do it. How do we think end investors can do it? Well, if you're looking at funds, I think you want your funds to be diversified. And there we see a bit of an issue, right? Because the last 10, 15 years have been so momentum driven that all of the big funds end up holding really similar stuff. And as a result, their returns behave in really similar ways. What I've got here is the 10 largest funds by assets in the balance category and their correlations versus one another, right? So are they moving together or are they moving differently? Now, some of these funds are active, some of them are passive. From looking at the correlations, you almost couldn't tell, right? Correlations of 88%, 94%, 98% correlations between these big funds. Our balanced fund is very different. The portfolio is very different from our competitors. As a result, our returns behave very differently. We are much less correlated with any of the big funds than they are with one another. And we've managed to deliver peer-beating returns. So we think we're a pretty good option. That's all I've got for you. To sum up very quickly, the S&P, we really believe, is dependent on great expectations. Great expectations are still in the price. If you want to believe you're going to get a great long-term return, you got to believe reality is going to be even more amazing than what's already expected. Now, what can you do about that? I think it's very simple. Just seek low expectations and get actually diversified. Thanks very much for your time.
Lovely, Rob. Thank you very much indeed. Just get questions up on the screen. Okay, first one. It says here, you have a contrarian approach. Give me 3 macro themes that Mr. Market is not seeing. The challenge for you, Rob.
Sure. Let me give you 2, and I'll come up with a third. So I think the first one's inflation, right? So within the multi-asset team, I look at treasuries, U.S. macro, inflation, that sort of thing. And when I look at what the market's pricing on inflation, they're pricing that in the next couple of years, it's going to go to 2, and then it's going to stay at 2 forever, right? Now, I think that's unlikely. That's been the case for most of the last 20 or 30 years, but you've had really powerful forces like globalization, like capital having power over labor, that held inflation down. Now, we think those forces are all at least stopped and that they're probably reversing, right? If you reverse a deflationary force, you're going to see higher inflation. We think 3.5% is a more realistic expectation over the long term. So that would be one. The other would be US recession risk. So Bank of America runs this big fund manager survey that came out recently. People are a little bit more worried than they were at the start of the year, but something like 70% of managers still expect a soft landing in the US. Now I look at that, I look at what's going on with US consumers. It's basically rich people spending. It's keeping the economy afloat. And what's keeping their spending afloat is the stock market going up. Well, it's no longer going up. So will they keep spending? Open question. And then I listen to what's coming from Trump and Treasury Secretary Bessent. And there's an American poet, Maya Angelou, who said, when people show you who they are, believe them the first time, right? And I hear Trump saying, oh, I don't want to forecast things like that, talking about a recession. Or, yeah, there might be some pain. I hear Bessent saying, there is no Trump put option, right? Or we're going to go through a period of detox. Now, if they want to let a recession happen in order to bring interest rates down, they absolutely can do it, right? And so I think it would behoove investors to listen. So we're more worried about a recession, more worried about inflation than a lot of our peers. I think the third one would be, this is going a bit more micro, but within Japan, we've seen enthusiasm in recent years. Pretty much all of that enthusiasm has been in the large caps off the back of things that the stock exchange is doing to improve capital allocation. We don't think that's the sweet spot, right? We think that's chasing a real opportunity, but in the wrong direction, right? We think the real sweet spot is in mid caps. So there are a lot of companies that trade at low valuations and have a lot of cash on their balance sheet, huge potential to improve shareholder returns. And if you're looking at smaller businesses, you are much more likely to find businesses that generate most of their revenue in yen. And so in an environment where the yen looks cheap, that's a problem for you if you're Toyota, if you're an exporter. It's not a problem for you if you're a smaller domestic business.
Very good. Next question. What is the approximate turnover in the portfolio? Do you think that a contrarian fund ends up with a higher turnover than your peer group?
Yeah, so I think, at Orbis, we invest with a 3 to 5 year horizon for individual securities. And so if you took the midpoint 4 years, you would say, well, turnover should be about 25%. In practice, it's a little bit higher than that. And the reasons are basically two. The first is you don't always have to wait 4 years to figure out if you're right or wrong on a stock. Sometimes something happens 6 months, 9 months in that breaks your investment thesis. Well, when that happens, we're disciplined, we sell. Sometimes on the happier side, the market comes around to your view much more quickly. The discount to intrinsic value narrows, and in those cases, we sell too. So I think normal over the long term would be name turnover of about 30, 35%, but that's a little bit higher when the opportunity set, when the environment is changing rapidly. It's a little bit lower when we like what we own, but things are getting more stretched. I think having a valuation focus can leave you having somewhat higher turnover than people with a quality focus. Right? People just want to find good businesses and hold them for a very long time and just let their valuation fluctuate. We don't want to own fairly valued stocks. We want to own undervalued stocks. And the market's views change over time. So whether, we might think something is a great business, if we think the market's view of the company is too rosy, notwithstanding our positive view on the business, we're going to sell.
Okay, we're a little bit over time, but just one or two more if that's okay, Rob. Could you talk through the decision-making process of when you make a new investment? This is a question for me separate to that. With such a diversified portfolio and so many different elements to it, do you have to become an expert on everything? Did different people take responsibility for different markets and sectors? How does that all come together in the team?
Sure. So let me handle the research process question separately to the portfolio management question. So the way we're structured at Orbis, so we've got about 4 dozen analysts around the world looking at individual businesses. The vast majority of those analysts express recommendations through paper portfolios. And so they're live right? That's a live recommendation. The price moves, you respond to it. Those paper portfolios are the raw materials for portfolio construction, and they're visible in real time to all of our portfolio managers across strategies, right? So that's the raw material. And it means that our analysts are very much expert on what they cover. The portfolio managers know the stuff well and do their own research, but they don't have to have the same degree of intense expertise on individual companies that the analysts do, right? That's really the analyst's job. The way the research process works is we think if you're going to be contrarian, it's hard because the market is going to be shouting at you every day that you're wrong, right? They disagree with you. If you're going to be able to stomach that and make good decisions, we think you need to understand what you own really, really well. And if you're going to build that degree of understanding, you need time, right? You need focus. And so the research process is designed to help our analysts reject ideas as ruthlessly as they can to focus on the best ones. So last year, for instance, we looked at over 400 companies over the course of the year. Only about 50 of those made it through to the other end of the process, right? So that's sort of what we aim to do in research. And then in portfolio construction, it's bringing together the raw materials from the ideas bubbling up from the analyst teams.
Okay, one final one then. In the portfolio, there was a term gold related. I've been asked to ask what that means exactly.
Yeah, so that'll be, so it's gold exchange traded products. Our compliance team is very insistent that we call it gold related and not gold. But that'll be exchange traded products backed by audited physical bullion in vaults.
Okay, so a proxy, if you like, for holding
Yes.
physical gold. Yeah, lovely. All right, Rob, thank you very much indeed. Thank you for joining. It's been fascinating, really interesting presentation. Nice to see something so different to everyone else as well. It's really refreshing.
No, thanks very much.